If you were 18 or older as of 2009 and you've never opened a TFSA, you have $109,000 of tax-free investing room that grows every January, whether you use it or not. The TFSA is one of the single most misunderstood financial products in Canada. People think it's a savings account, but it's not. And if I had my way, I would rename it to the tax-free investing account. Many people think withdrawals are simple, but there are some complexities that you need to be aware of. And every single year, thousands of Canadians get penalty letters from the CRA for over-contributing to their TFSA. So this video is the complete guide, how to make contributions, how to grow your wealth, and the 4 penalties and traps that catch people every year, and one of them can actually shrink your contribution room. I'm Janine, I'm a CPA, and I'm here to help you build your wealth. So what actually is the TFSA? I think this is the biggest misconception, and many people use it as a savings account, probably because of the S in the name. But realistically, it's not a savings account. It is a container where you can hold different investments. You can hold things like cash, GICs, stocks, bonds, ETFs, mutual funds. The list is long for the things that actually go into your TFSA. But here's what makes the account powerful. With any normal investment, any growth or dividends or interest you earn is taxable in the year you earn them. But with the TFSA, your growth is tax-free, your dividends are tax-free, and your withdrawals are also tax-free. They don't count as income, which means that they also don't claw back your OAS. Let's compare that for a second to the RSP. When you make a contribution to your RSP, you get a deduction on your tax return that lowers your taxable income, meaning you'll pay less tax in that year. But fast forward to when you pull that money out, you are going to have to pay tax on it. The income you earn in your RSP and the money you grow within your RSP is tax deferred, not tax free. So who can open a TFSA? Well, any Canadian resident over the age of 18 can open a TFSA. There's no income threshold and you don't have to file a tax return to accumulate room. So now here's the part that everybody gets wrong, your contribution room. For every year you are 18 years of age or over, you get more contribution room every January 1st. For 2026, that number was $7,000, but this number is indexed to inflation, so we may see $7,500 in 2027. Your room is cumulative and it starts building the year you turn 18. So if you're turning 18 in 2026, you only have $7,000 worth of contribution room. Whereas if you're 35 this year and you've turned 18 in 2009, you'll have $109,000 of lifetime contribution room. Every unused dollar of contribution room carries forward without you needing to do anything. There's no use it or lose it. You can catch up on your contribution room in a later year. But here are 3 rules that people often miss. First is the limit is across all of your accounts. You can have 12 different TFSAs if you want, but it's your responsibility to track and make sure that you're not going over your lifetime contribution room. The CRA really doesn't care where you have this money, just that you're not going over that lifetime limit. The second is that growth doesn't count against your contributions. So if you contribute $50,000 and that grows to $150,000, you aren't out of contribution room. You've only used $50,000 worth of room. That $100,000 worth of growth is tax-free. And this is why starting early is so important. And third, the data in the MyCRA account can often be out of date. Your bank only reports TFSA transactions at the end of February of the following calendar year. So many times, the number in your MyCRA account won't accurately reflect where you're at with your contributions. So it is super important that you track this number and make sure that you're not going over it. And I've actually created a template that helps you do exactly this. So how big can your TFSA actually get? Let's say you started contributing $7,000 this year and you committed to maxing out that $7,000 contribution every year for 25 years. And for the sake of this argument, we're going to say that the TFSA contribution room stays the same every single year. Now, there are 3 scenarios over 25 years. The first is keeping that money in cash at 1.5%. Oftentimes, when you open a TFSA and put money in, people will think that they're investing in it, but realistically, it's sitting in cash earning less than 2%. Over those 25 years, your money will grow to about $215,000. Now, in that same time period, you've contributed $175,000. Your account has barely done anything. The second is leveraging what we call a GIC or guaranteed investment certificate. Maybe you're able to get a rate of return of about 3.5%. Again, over 25 years, you're going to end up with about $285,000. Remember, we contributed about $175,000. Now, the third scenario is investing in the stock market. And if you're using a diversified ETF, it's likely you'll be able to get around 7% in this account that grows completely tax-free. This means you'll grow your wealth to roughly $475,000, close to $500,000 over those 25 years. And you've only actually made $175,000 worth of contributions. This is where the TFSA is most powerful. Of that $300,000 in growth, you're going to pay tax on $0 of it. Because you kept your money in the TFSA, when you go to pull out that $475,000, none of it is taxable, none of it impacts your income, and none of it claws back your OAS. This is why what you hold in your TFSA is one of the most important questions you can ask yourself as a Canadian. There are thousands of Canadians that have their money sitting in cash within their TFSA and not actually growing their wealth. If you're earning less than 7% in your TFSA, you are missing out on potential growth, and you might be saving yourself $100 in tax a year. Whereas if you actually strategically use the TFSA, you can save yourself hundreds of thousands of dollars in tax over the course of your life. Now, obviously, we want our investment risk to match our investment timeline. So if you need this money within the next couple of years, investing it within the TFSA is probably not the place for it. As a reminder, these are illustrations and not guarantees. Markets go up and down, but the average rate of return for the S&P 500 is about 10% per year. Now, withdrawals are where people can sometimes get confused. Anything you withdraw from your TFSA is considered tax-free, which is great. And what's powerful about the TFSA, anything you withdraw is added back to your contributions in the following calendar year. So if I withdraw $10,000 on June 1st, I can put that $10,000 back into my TFSA on January 1st of the following calendar year. But here's the catch. If you withdraw that $10,000 on June 1st and your TFSA is maxed out and you recontribute that $10,000 before January 1st, you will generate a penalty. The contribution room you get from your withdrawals does not reset until January 1st of the following calendar year, not immediately. And if you do recontribute that money and you are in a position where you have over-contributed to your TFSA, the CRA is going to charge you 1% of your over-contribution per month until that money is pulled out. This is a letter from CRA you don't want to get. So remember, if your TFSA is maxed out and you make a withdrawal, you cannot recontribute that money until January 1st of the following calendar year. Now, obviously, if you have additional room in your TFSA, you can continue to make contributions, but remember, that amount that you withdrew cannot be contributed until January 1st of the following year. And one more little quirk with withdrawals. You get back what you made in withdrawals, you contributed. The CRA isn't going to be able to calculate how much your original contribution has grown by the time you withdraw it. So in an extreme example, if you grow your TFSA to $250,000 and withdraw that total amount, on January 1st of the following calendar year, you're going to be able to recontribute $250,000, not the $109,000 lifetime maximum. Hold on to that thought because there is kind of a reverse trap that I'll get into next. So here's the section that's going to save you real money. 4 traps that you can fall into in order of how frequently they happen. The first is over-contribution. We've talked about this a little bit before, but any amount you over-contribute to your TFSAs across all of your different TFSA accounts will be charged a 1% per month penalty by CRA. This is why it's so important to track your TFSA contributions in real time, because if you notice you've made an over-contribution, you want to withdraw that money right away. The second trap is that losses shrink your contribution room forever. So remember that example where I said we could pull out $250,000 and recontribute it based on our growth? The same is true for losses. So if you put $7,000 into your TFSA and the investment you choose drops down to $1,000 and you make a $1,000 withdrawal, you only get $1,000 worth of contribution room back on January 1st of the following calendar year, not the total $7,000 you originally contributed. So we want to make sure that we're not withdrawing money when we're sitting in a loss position. And because this is a tax-free account, you cannot claim the capital loss on your tax return. You are just stuck with a lower contribution room to your TFSA forever. You Cannot appeal this. There is no way to change this. Trap number 3 is day trading. We've seen this time and time again for people that trade actively within their TFSAs. If the CRA decides that you are actively trading in your TFSA, they're going to count this as business income. That means your tax-free status within that account is going to be revoked. But don't worry, most people won't count as day traders unless they're making a lot of high volume trades within their account. But if you're just contributing to diversified ETFs on a monthly basis or even a weekly basis, that's not going to be considered active trading. And trap number 4 is US dividends. The TFSA is tax-free to Canadians. However, the US doesn't view it as such. Any US stocks or ETFs that are traded on a US exchange that pay dividends are subject to a 15% withholding tax. Growth on stocks and ETFs is largely unaffected within this account. And Canadian dollar dividends are not affected either. Only US dividends are subject to this 15% withholding. And now that's not a reason to not hold these stocks or investments in your account if they make sense to. It's just something to know when you're making a decision about what account your investments should live in. So let's break down your TFSA action plan. The first is figure out how much contribution room you actually have in this account. You need to understand your cumulative limit minus everything that you've ever contributed to your TFSA. And then we're going to add back those withdrawals again on January 1st of the following calendar year. Please don't blindly trust the number in My CRA. Make sure that you are tracking this on your own. And again, I've made a template that I'll link below in the comments if you're interested in grabbing that. The second step is you want to open a TFSA in a place that allows you to invest, not just keep it in cash or in a savings account or GIC. Earning 3% is not enough to grow your wealth. You need to be earning 7 to 10% per year on average in your TFSA to build real wealth. If you're looking at switching institutions, please make sure you use the formal transfer to actually move this money so that you're not impacting your contribution room. Step 3 is match your investments to your own personal timeline. So if this money is set aside for investing in your retirement, which it absolutely should be, then you want to invest in long-term growth equity ETFs and stocks. Please do not keep this money in cash. But if you're going to need this money in the next 1 to 2 years, then cash or GICs might be the right place for it. Number 4, automate your contributions. Whether it's $7,000 on January 1st of every calendar year or breaking it down into monthly contributions of $583 per month, we want to make sure that we're always contributing to our TFSA, even if it is a small number. I started contributing to my TFSA with just $25 a month. And while I wasn't anywhere near close to maxing that account out when I was 18, it did build the habit, and I was able to increase those contributions and catch up on my lifetime contribution over the years. If you're interested in seeing how I'm building a $1 million TFSA by the time I'm 45, I will make sure that that video is linked in the description below. And lastly, track your contributions all in one place across all of your different TFSAs. The CRA doesn't always have the most accurate number in your My CRA account. It is your responsibility to make sure that you do not over-contribute. As I mentioned, I've created a template that allows you to track this for less than the cost of an oat milk latte, and I will make sure that that is linked in the description below. If this saved you from even one of the potential traps I listed, subscribing to my channel genuinely helps. I try to make Canadian-centric finance content because so much of what we find online is American-based. If you have any questions about the TFSA, please drop them in the comments section below, and I will see you next week.